What's happening right now in the precious metals market is something most people aren't prepared for. And I'm not talking about the headlines you're seeing. I'm talking about what's happening behind closed doors, in the vaults, in the trading pits, and in the central bank boardrooms across the world. Because while everyone's distracted by the noise, there's a silent transfer of wealth happening that could leave millions of Americans on the wrong side of history. Let me show you what I mean. Gold just shattered its all-time high, pushing past levels that analysts said were impossible just months ago. Silver followed suit, breaking through resistance that had held for years. But here's what nobody's telling you. This isn't just a rally. This is the beginning of a structural shift in how wealth is stored, protected, and transferred globally. And if you're holding paper assets, cash, or traditional retirement accounts without any physical precious metals exposure, you need to understand what's coming. Think about this for a second. When was the last time you saw gold and silver move in lockstep like this? When was the last time central banks around the world were buying physical gold at record pace while simultaneously telling their citizens that inflation is under control? There's a disconnect here, a massive one. And that disconnect is your signal. Let me take you back to a moment in history that most people have forgotten. It was 1971. President Nixon closed the gold window, severing the dollar's last tie to physical gold. At that moment, gold was trading at around $35 an ounce. Within 9 years, it had rocketed to over $800. That's not a typo, a 2,200% increase. But here's what's important. It wasn't the announcement that made people wealthy. It was the people who understood what was happening and positioned themselves before the crowd caught on. Now, I'm not saying we're in 1971, but I am saying that the structural forces at play right now rhyme with that period in ways that should make you pay attention. We're seeing currency debasement on a scale that would have been unthinkable a generation ago. We're seeing geopolitical fractures that are forcing nations to rethink their entire monetary strategy. And we're seeing a physical supply crunch in silver that's unlike anything we've witnessed in modern markets. Before I go further, I want to make sure you have access to something I put together. It's a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's in the description below. No cost, no obligation. Just information that could help you make better decisions about your financial future. Grab it while it's still available. Now let's talk about what's actually driving this market. Because if you understand the mechanics, you'll understand why this isn't just another bull run that's going to fizzle out. This is different. And the difference comes down to three things: supply, demand, and the paper market structure that's been masking the true price of these metals for decades. Start with supply. Silver production has been declining. Not because miners don't want to dig it up, but because the easy deposits are gone. The high-grade ore bodies have been exhausted. What's left requires more energy, more capital, and more time to extract. Meanwhile, industrial demand for silver is exploding. Solar panels, electric vehicles, 5G infrastructure, medical devices. Every single one of these technologies requires silver. And not just a little bit. We're talking about ounces per unit. Multiply that across billions of units being manufactured globally, and you start to see the problem. But here's where it gets interesting. The COMEX, the exchange where silver futures are traded, has been operating on a fractional reserve system for years. What does that mean? It means that for every ounce of physical silver that actually exists in their vaults, there are multiple paper claims on that same ounce. It's like a bank that loans out the same dollar to 10 different people and hopes they don't all ask for it back at the same time. Well, guess what's starting to happen? People are asking for it back, and the vaults are running low. I want you to imagine something. Imagine you're holding a ticket to a concert. You bought it months ago. You're excited. You show up at the venue, and there are 10 other people holding the exact same ticket for the exact same seat. That's what's happening in the silver market right now. Except instead of a concert, we're talking about a metal that's essential to modern technology and has been used as money for 5,000 years. Now let's talk about gold, because while silver is the high-octane play, gold is the anchor. It's the asset that central banks are accumulating at a pace we haven't seen since the 1950s. China, Russia, India, Turkey, Poland. These aren't small players. These are nations that are actively diversifying away from dollar-denominated reserves and into physical gold. Why? Because they see what's coming. They see the debt levels. They see the currency instability, and they're protecting themselves. Here's a story that didn't get enough attention. A few years ago, Germany requested that the Federal Reserve return a portion of its gold reserves that had been stored in New York. The Fed agreed. But instead of shipping it back immediately, they said it would take 7 years. 7 years to return gold that was supposedly sitting in a vault ready to go. Why would it take 7 years? Because either the gold wasn't there, or it was leased out, or it was being used for other purposes. Whatever the reason, it sent a signal to every other nation with gold stored abroad: get your gold home. And that's exactly what they've been doing. This is the part where most analysts stop. They give you the data, they show you the charts, and they leave you to figure out what to do next. But I'm not going to do that. Because understanding the problem without understanding the solution is just anxiety. And anxiety doesn't protect your wealth. So let's talk about what this means for you. If you're sitting on retirement accounts, savings, or investments that are entirely denominated in paper assets, you're exposed. Not because those assets are bad, but because they're all tied to the same system, the same currency, the same central bank policies. And when that system comes under stress, everything moves together. Stocks, bonds, real estate, they all correlate. But physical gold and silver, they move differently. They're the insurance policy that pays out when everything else is burning. Now, I know what some of you are thinking. You're thinking, I've heard this before. Gold bugs have been predicting collapse for decades, and it never happens. And you're right. There are people who have been wrong about the timing. But here's the thing. Being early doesn't mean being wrong. It just means you're positioned before the crowd. And in markets, being early is how you capture the real gains. Let me give you an example. In 2008, when the financial crisis hit, gold was trading around $800 an ounce. By 2011, it had nearly tripled. The people who bought in 2005 and 2006 were called crazy. They were told they were wasting their money. But when the crisis hit, they were the ones who preserved their wealth while everyone else watched their portfolios implode. Here's another angle that doesn't get talked about enough: the velocity of money. It's a term economists use to describe how fast money changes hands in an economy. When velocity is high, it means people are spending, investing, and transacting. When it's low, it means money is sitting idle. Right now, velocity is at historic lows. Why? Because people don't trust the system. They're hoarding cash. They're waiting. But here's the problem with hoarding cash. Cash loses value every single day due to inflation. So what's the alternative? Hard assets. Things that can't be printed. Things that have intrinsic value. Things like gold and silver. Let me paint you a picture of what's happening in the physical market right now. Dealers are reporting premiums on silver coins and bars that are higher than they've been in years. What does that mean? It means that the price you see on the screen, the spot price, isn't the price you actually pay when you go to buy physical metal. You're paying a premium on top of that, and that premium is a signal. It's telling you that there's more demand than supply. It's telling you that people are willing to pay extra just to get their hands on the real thing. And it's not just retail buyers. It's institutions. It's family offices. It's high net worth individuals who are quietly accumulating physical metal and storing it outside the banking system. They're not doing this because they think the world is ending. They're doing it because they understand risk. They understand that diversification isn't just about owning different stocks. It's about owning different types of assets that respond to different types of crises. Now let's talk about something that's uncomfortable but necessary: the role of government in all of this. Because whether you like it or not, government policy is one of the biggest drivers of precious metals prices. And right now, governments around the world are in a bind. They have debt levels that are unsustainable. They have entitlement programs that are underfunded. And they have populations that are demanding more services, more benefits, and more support. How do they pay for it? They print money, they issue debt, and they hope that inflation stays just low enough that people don't revolt. But here's the problem. Inflation isn't staying low. It's accelerating, and not just in official government statistics. In the real world, in the grocery store, at the gas pump, in healthcare costs, in education. People are feeling it, and when people feel it, they start looking for alternatives. they start asking questions. And one of those questions is, how do I protect what I've worked my entire life to build? This is where physical possession comes in. And I want to be very clear about this. I'm not talking about paper gold. I'm not talking about ETFs. I'm not talking about mining stocks. Those all have their place. But they're not the same as holding physical metal in your hand. Because when you own an ETF, you own a share of a fund that owns gold. You don't own the gold. When you own a mining stock, you own a piece of a company that digs gold out of the ground. You don't own the gold. But when you own a physical coin or bar, you own the gold. And that distinction matters. Let me tell you why. In times of crisis, counterparty risk becomes everything. Counterparty risk is the risk that the other party in a transaction won't hold up their end of the deal. When you own an ETF, your counterparty is the fund manager, the custodian, the bank that holds the gold. When you own a mining stock, your counterparty is the company, the management team, the government that regulates the mine. But when you own physical metal, your counterparty is yourself. There's no middleman. There's no institution that can freeze your account, change the rules, or tell you that your claim isn't valid. And this brings me to something that's critically important for anyone who's thinking about retirement. If you have $100,000 or more in retirement accounts, you need to understand that there are ways to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and it's one of the most powerful wealth protection tools available to American retirees. I put together a guide that walks through exactly how it works, what the rules are, and how to set one up. It's in the description. No sales pitch, just information. Because I believe that informed decisions are better decisions. Now back to the market dynamics. Because there's another layer to this that most people miss. The relationship between gold and silver. Historically, the gold to silver ratio has averaged around 15 to 1. That means it took 15 ounces of silver to buy 1 ounce of gold. But right now, that ratio is much higher, which means silver is undervalued relative to gold. And when that ratio reverts to the mean, which it always does eventually, silver tends to outperform gold on a percentage basis. That's why silver is often called the poor man's gold. It's more volatile, it's more industrial, but it also has more upside potential when the market turns. Let me give you a real-world scenario. Let's say you're a retiree. You've got your savings in a mix of stocks, bonds, and cash. You're drawing down a little bit each year to cover your expenses. Everything's fine, until it's not, until there's a market crash, until there's a currency crisis, until there's a geopolitical event that sends shockwaves through the financial system. What happens to your portfolio? It drops. Maybe 20%, maybe 30%, maybe more. And now you're in a position where you have to sell assets at depressed prices just to cover your living expenses. That's the nightmare scenario. That's what keeps people up at night. But what if you had allocated even 10 or 15% of your portfolio to physical gold and silver? What if, when everything else was dropping, those metals were holding their value or even going up? Now you have options. You can sell a little bit of your metal to cover expenses while you wait for your other assets to recover. You're not forced to lock in losses. You're not panicking. You're protected. This is the power of diversification done right. It's not about putting all your eggs in one basket. It's about making sure that when one basket breaks, you have another one that's still intact. And physical precious metals are that other basket. They're the asset class that moves inversely to paper when the system comes under stress. Now, I want to address something that comes up a lot. People say, but gold doesn't pay dividends. It doesn't generate income. Why would I own something that just sits there? And it's a fair question, but it misses the point. Gold and silver aren't income-generating assets. They're wealth preservation assets. They're insurance. You don't buy insurance because you want it to pay you every month. You buy insurance because you want protection when something goes wrong. And in a world where central banks are printing trillions, where governments are running deficits that would have been unthinkable a generation ago, where geopolitical tensions are rising, you need that insurance. Let's talk about the geopolitical angle for a minute, because this is huge, and it's not getting the attention it deserves. We're watching the emergence of a multipolar world. For the last 75 years, the US dollar has been the global reserve currency. Every country needed dollars to buy oil, to settle international trade, to hold as reserves. But that's changing. The BRICS nations, Brazil, Russia, India, China, South Africa are actively working on alternatives to the dollar. They're settling trade in their own currencies. They're building payment systems that bypass the US-controlled SWIFT network. And they're accumulating gold as a neutral reserve asset that no single country controls. What does this mean for you? It means that the demand for dollars is going to decline. And when demand for dollars declines, the value of the dollar declines. And when the value of the dollar declines, everything priced in dollars, including your savings, loses purchasing power. Unless you're holding assets that aren't denominated in dollars, assets like gold and silver. Here's a story that illustrates this perfectly. In the early 2000s, Russia was heavily sanctioned by Western nations. Their access to the global financial system was restricted. So what did they do? They started accumulating gold, massive amounts of it. They sold off their US Treasury holdings and bought physical gold. And when the sanctions intensified, when their currency came under pressure, that gold became their lifeline. It gave them the ability to settle trade, to stabilize their currency, and to maintain economic sovereignty. Now, I'm not making a political statement here. I'm making an economic observation. Gold gave them options when paper assets didn't. And it's not just Russia. China has been doing the same thing. For years, they've been quietly accumulating gold through official channels and through private imports that don't show up in the official statistics. Why? Because they know that in a world where the dollar's dominance is fading, gold is the ultimate neutral asset. It's the asset that every nation respects. It's the asset that can't be sanctioned, can't be frozen, and can't be devalued by a central bank printing press. Now let's bring this back to the individual level, because all of this macro stuff is interesting, but what really matters is what it means for your personal financial situation. And here's the bottom line. If you don't own any physical precious metals, you're taking on more risk than you probably realize. You're betting that the current system will continue to function smoothly. You're betting that your currency will hold its value. You're betting that there won't be any major disruptions. And maybe you're right. Maybe everything will be fine. But what if you're wrong? This is where the concept of asymmetric risk comes in. It's a fancy way of saying that the downside of not owning gold and silver is much greater than the downside of owning it. If you own physical metal and nothing bad happens, you still have an asset that has held its value for thousands of years. You haven't lost anything. But if you don't own it and something does happen, you could lose everything. That's asymmetric risk, and it's why smart money is allocating to physical precious metals right now. Let me give you another historical example. In the 1920s, Germany experienced hyperinflation. The currency became worthless. People were using wheelbarrows full of cash to buy a loaf of bread. Savings were wiped out overnight. But the people who had converted their paper money into gold before the collapse, they preserved their wealth, they were able to rebuild, they survived. And the lesson from that period is as relevant today as it was 100 years ago. Paper money is only as good as the government that issues it. But gold is gold. It doesn't depend on any government's promise. Now, I'm not saying we're headed for Weimar Germany-style hyperinflation, but I am saying that the risks are higher than most people acknowledge. We have debt-to-GDP ratios in major economies that are at levels historically associated with currency crises. We have central banks that are trapped. They can't raise interest rates without crashing the economy, and they can't keep rates low without fueling inflation. It's a no-win situation, and in a no-win situation, the smart move is to protect yourself. Here's something else that's happening that you need to know about. The physical silver market is showing signs of stress that we haven't seen in decades. Industrial users are starting to panic because they can't secure the supply they need. Mints around the world are reporting delays in production because they can't get enough raw material. And the COMEX inventories are at levels that, if you understand the mechanics of the market, should be setting off alarm bells. Think about it this way. Silver is used in everything from smartphones to solar panels to medical equipment. It's not optional, it's essential. And unlike gold, which is mostly recycled, silver gets consumed. It gets used up in industrial applications and it's gone. So every year, we're drawing down the above-ground supply. And at some point, that supply runs out. When that happens, the price doesn't just go up, it explodes. Because industrial users will pay whatever it takes to keep their production lines running. And here's the kicker. Most of the silver that's mined comes as a byproduct of other metals like copper, lead, and zinc, which means that silver production is tied to the economics of those other metals. If copper prices drop and mines shut down, silver production drops too, even if silver prices are high. It's a structural problem that can't be fixed quickly, and it's setting up a supply-demand imbalance that could send prices to levels that seem unthinkable right now. Let me ask you a question. If you knew that a critical resource was running out, and that demand for that resource was increasing, and that there was no easy way to increase supply, what would you do? You'd secure as much of that resource as you could, as early as you could. That's exactly what's happening in the silver market right now. The smart money is accumulating, the institutions are accumulating, and the retail investors who understand what's happening are accumulating. But here's the thing. This window won't stay open forever. At some point, the price will reflect the true supply-demand dynamics. And when that happens, the opportunity to buy at these levels will be gone. You'll be chasing the market instead of positioning ahead of it. And in markets, chasing is how you lose money. Now, I want to talk about something that's deeply personal, your legacy. Because this isn't just about protecting your wealth during your lifetime. It's about what you leave behind for your children and grandchildren. And in a world where currency is being debased, where debt is exploding, where the purchasing power of a dollar is eroding every single year, what's the best way to preserve wealth across generations? Physical gold and silver have been the answer to that question for thousands of years because they're portable, they're divisible, they're universally recognized, and they can't be destroyed. You can pass them down to your heirs without worrying about whether a company will still exist, whether a government will honor its promises, or whether a currency will still have value. It's wealth in its purest form. And here's something that doesn't get talked about enough: the psychological benefit of owning physical metal. There's something deeply reassuring about holding a gold coin in your hand, about knowing that you have real wealth that exists outside the financial system. It's not just a number on a screen. It's not dependent on a bank staying solvent or a government staying stable. It's yours. And in uncertain times, that peace of mind is priceless. Let me bring this full circle. We started by talking about what's happening in the markets right now: the record highs in gold, the explosive moves in silver, the central bank buying, the supply constraints, the geopolitical shifts. All of these are pieces of a larger puzzle. And when you step back and look at the whole picture, what you see is a system that's under stress, a system that's reaching the limits of what it can sustain, and a system that's going to force people to make choices about how they protect their wealth. You can choose to ignore the signals. You can choose to believe that everything will work out fine. You can choose to keep all your wealth in paper assets and hope for the best. Or you can choose to take action. You can choose to allocate a portion of your portfolio to physical precious metals. You can choose to secure your future with assets that have stood the test of time. And if you're someone who's been watching this market, who's been thinking about making a move but hasn't pulled the trigger yet, I want to leave you with this. The best time to buy insurance is before you need it. Once the crisis hits, it's too late. The premiums skyrocket, the availability disappears, and you're left scrambling. Don't be that person. Be the person who saw what was coming and positioned accordingly. For those of you who've made it this far, I want to offer you something exclusive. If you're an American retiree with at least $100,000 in any retirement account, you can get access to a one-on-one educational web conference. No obligation, no sales pressure, just a conversation about how to protect your wealth in these uncertain times. It's only available to people who mention they watched this video all the way through. The details are in the description. Take advantage of it while it's still available. The bottom line is this: we're living through a period of monetary history that will be studied for generations. The decisions you make right now, the actions you take in the next few weeks and months, will determine whether you're on the right side of the wealth transfer that's happening. Physical gold and silver aren't just investments. They're survival tools. They're wealth preservation in its most fundamental form. And in a world where everything else is uncertain, they're the one thing you can count on. Don't wait until it's too late. Secure your future with physical possession. Act fast.